Hello everyone, welcome to the Alpha Hustle and the Market Profile Paathshala series that talks about the market profile starting from the basics to the advanced concepts. Let's jump right into today's chapter. So this is a chapter 2 of the Market Profile series. In this chapter, we'll understand the different open types. The concept of opening types helps one in measuring the confidence at which the market's auctioning right from the open. This helps setting the context for the day and potential scenarios that may likely to play out for the rest of the day. This not only helps in forming a bias, but also helps in not getting caught on the wrong side of the trade. The first of the opening types is the open drive. So the price starts to move in one direction right from the open. In majority of the cases where open drive occurs, market opens near the value area extremes and drives out of the range in one direction. It could be either on the upside or on the downside. This marks the high confidence or conviction with the presence of other time frame traders who controls the auction exploring the fair value that changes rapidly, creating a trend. These are typical days where one should avoid mean reversion attempts or fading the trend. This is an ideal type of the day where one should follow the trend by buying the breaks in case of bullish move while selling the rips in case of a bearish move. So the second opening type is the open test drive, OTD. This type of open where market tests a significant zone or a reference before making a directional move. As shown in the picture, prices test the previous day's value area low where prices get rejected to drive lower. Open test drive often helps in figuring out the change in the context. So the trading is all about change. So understanding the change in the context is very important. Value area low shown here is just an example. It can be any such visual reference on the charts. We'll talk about the references in a separate chapter, but essentially open test drive is where market tests a particular reference and then changes the context from there on. The next of the open types is the open rejection reverse. Prices open at an extreme and sees a sharp rejection to head in the other direction. This often occurs when the markets attempt to make swing highs or lows. So from the example, market opens within the previous day's value area, looks above the weekly highs, gets rejected swiftly to head in the opposite direction, forming value lower. So this marks a change in the context and the intermediate term forming a swing. So this is a typical type of the day where one should avoid trades until the open confidence is confirmed and switch the trades immediately on change of the context. The last open type is open auction. Market opens within the previous day's balance with no serious commitment either from the buyers or sellers in making a directional move. So the market auction lacks conviction where the market participants agree on a fair value and trade back and forth with no conviction whatsoever. So this is an ideal type of the day where we may potentially have a range expansion over the next few sessions. These narrow ranges typically denote range contraction that may soon turn into a range expansion. So the ideal type of trades with this type of open is to fade the range extremes from the prior day. So spotting the open types is really important in setting the bias for an open trade. But how do we anticipate the probable open types? Well, that depends on where the market opens. Market open with respect to previous day's settle or close gives a view on where the market is likely to open and play out for the subsequent session. So this would help us to understand if there would be an opportunity for an early morning trade. So the first type of the open that we're going to talk about is the market opening right within the yesterday's range and value area. So this is a low confidence open where the market thinks that the fair trade still remains the same as of yesterday. With this kind of open, odds are high for an open auction or an open test drive. So prices are likely to be choppy and any early entries could get chopped out in this type of open. Range expansion likely only if either of the prior days high or low is taken out. The next type of the open is market opening within yesterday's range, however, outside of the value area of the prior day. So this is a good confidence open where the prices reject the previous day's value area and opens either at one of the extremes that suggests that the odds are in favor of an open drive or an open test drive. So this kind of open provides early trading opportunities with the traders who are showing some confidence. The next type of open is open auction out of the range. It could be either a gap up or a gap down. So this is a very high confidence open that gives the higher odds for an open drive and early trading opportunities. So one of the mistakes that the novice traders do is fading the gaps. Never attempt to fade the gap. The bigger the gap, the odds are higher for the market to continue in the direction of the gap, often forming a trend day. Context gets changed only if the gap gets filled immediately, making it an open rejection reverse. So in case of a gap, follow the gap as long as it doesn't get filled, and the odds favor buying the breaks during the gap up while selling the rips during the gap down. So that's all for today. I hope this information has been helpful. If you found this content useful, please do like, share, and subscribe. We'll see you in the next chapter. Thank you.